Hello friends, today I am going to talk about balance sheet reconciliation for fixed assets. In this video, you will find the accounting treatment for fixed assets, depreciation, capital work in progress, and then for the reconciliation, what are the items you need to check. So let's begin. So let's start with the meaning of fixed asset. What is the meaning of fixed asset? Before we start accounting or depreciation, let's understand what is the meaning of fixed assets. So fixed assets are tangible items companies own and use in their business operations for long-term financial benefit. Here if you see two words I have made it bold, that is business operations and long-term financials. And why it is important, I'll tell you through the example. So fixed assets are tangible assets. That means you can touch and see. Okay, that is the first point. Second, it has to be used in the business operation. And with what purpose? The purpose is that by using these assets, you earn financial benefits in long run, not that you are using only for a short period. Okay. Now let's start with an example. Suppose you are going to create a business, okay, and you have decided that you are going to set up a restaurant business, right? Now for setting up a business, you require a lot of things, right? One is assets, and second is your current assets. That means your grocery items or food items, what you want to convert to food items and you want to give to the customer. Now, when you're setting up this restaurant, let's see what are the items you require immediately at the time of setting it off. The first is building, right? You may make a building with a chimney facility, okay? You may buy gas stoves because that is very much required for cooking and furnitures, right? When your customers will come to the restaurant, they have to sit, right? Table, furniture, whether it is of less value, high value, you want to make a very costly restaurant, it depends on you. But these are the minimum requirement what I was showing you in the left side. Now, all these what you see in the left side, chimney, gas stoves, or furniture, these are to be used for long term, right? It's not that you use the gas stove for 2 months and you take it out, or you have a chimney you take out in 2 months, right? The furniture what you have in the restaurant you take it out within 3 4 months. It's not. The purpose is that you have invested with a purpose that I will be using these assets for a longer period, right? Now, to run the business, right? Your day-to-day expenses has been incurred. What? Like for example, you buy raw material. It could be vegetables. It could be your grocery items, right? And the salary you pay to your chef, right? So if you see on the right side, for day-to-day expenses, what you spend, these are part of your profit and loss account to determine your profitability. But what you see in the left side, the one-time investment or the investment which is made by the company so that you get long-term financial benefit, right? By using these assets, you are using your day-to-day expenses and generating revenue, correct? So the items like chimney, gas stoves, furniture are called as fixed assets. Now let's try to understand few examples of fixed assets. Those are used in the large manufacturing business. Okay, so let's see what are the fixed assets used. First one is the land and building, right? And when I say here land and building, generally it talks about the factory or the manufacturing unit, right? So land is obviously a asset, and the building what is constructed on the land is also a fixed asset because the purpose of the land and building is for a long term. It's not that you are going to use for a short term, right? Then plant and machinery, right? The machines will be used to convert the raw material into the finished goods. Then IT assets, furnitures, vehicles. Okay, so these are few examples. There could be many. Now, the manufacturer uses these assets for manufacturing the final product. There may be assets which are used directly and indirectly in the production. So here somebody may say that how furniture is an asset or how the IT asset used in the admin building is a asset. These are also asset, right? Because indirectly it contribute to the production. Because the person who is working, the engineer who is making the design, he may not stand in the factory or inside the factory and prepare that design, right? He'll be doing in the admin building. He's contributing indirectly to the production, and the assets used by this person who is sitting inside the factory or inside the admin building, even his items or his assets will be called as indirect assets. Intention of the manufacturer is to use these assets for a long period, that is more than 12 months. And in the financial statement, these assets are reported as non-current assets, right? Current assets means assets which you are going to convert into cash in next 12 months time. And these are called as non-current because you are not going to sell nor you want to convert these assets into cash in 12 months time. It is for a longer period. Now we have understood what is the meaning of fixed asset. Now we'll move towards the accounting part. So before we start posting entries for fixed assets, we should know as per the accounting standard, what are the costs need to be included as part of the fixed asset cost, right? So let's understand what are the items need to be included to be considered for the fixed asset cost. So let's take an example like plant and machinery. Okay, now let's see what are the costs need to be capitalized. The first one is invoice value. Okay, mostly the invoice what is raised by the vendor. Second is freight cost. Then is insurance, installation cost, consultant cost for designing, fitting, etc. Even though consultant is not directly involved in the asset procurement, but if the design or any other thing has been prepared by the consultant and based on that the vendor has manufactured the asset, then the consultant cost also be added to the cost of the fixed asset. Testing cost before start of production. So you want to do a testing. So for that you would have bought some raw material, you would have used some labor. So whatever cost you have been incurring at the time of testing the asset, that cost also you need to add back to the fixed cost, fixed asset cost. Borrowing cost, any loan you have taken to buy that asset, the interest what you have paid from the date of loan till start of production, or you can say till use of the asset, that interest cost has to be loaded back to the fixed asset. Investments made to increase the efficiency of the machine. Sometimes it may happen that there is a breakdown and a major portion of the asset has to be changed and the efficiency of the asset will be increased or the life of the assets will be increased. Those investments also can be capitalized. Non-creditable tax like basic custom duty, right? When you import, if you pay BCD to the customs authority, that is non-tax creditable item. So that has to be added back to the fixed asset cost. Now, what you should reduce from the fixed asset cost? GST is charged by vendor if tax input credit can be availed, right? So here you see in the left side, you can see invoice value or freight cost, insurance cost, installation cost, or consultant cost. If these guys are charging GST to you and you are able to take credit for that, then you can remove that GST portion and the net invoice value has to be capitalized. Then monetary government grant received after achieving milestone agreed with the government. So if you are signing any MOU with the government or there is any scheme where you get a benefit from the government by achieving certain milestones, in that case the money what you get from the government can be reduced from the cost of fixed assets. Now let's take an example to have more clarity. XYZ Limited purchased machinery from ABC Limited. Below are the cost incurred by XYZ Limited to get the machinery. ABC Limited invoice value was 1,30,000, which includes a GST amount of 10,000. Freight cost is 2,000. Insurance cost 1,000. Installation cost is 3,000. What is the cost of fixed asset to be capitalized if ABC Limited is allowed to take GST input credit, right? So here is the solution. Cost to be capitalized, ABC Limited invoice value 1,20,000. Why 1,20,000? Because GST credit you can avail, right? So that can be taken as a different asset category where you will be utilizing when you pay GST liability. So 1,20,000 is the cost what you're taking here. Freight cost 2,000, insurance 1,000, installation 3,000. So the cost, the total cost of machine is 1,26,000. Now let's see about the accounting of fixed asset. In the previous slide, we understood that what is the amount to be capitalized. Now let's see what journal entry to be posted. Right? I'm taking the same example. The cost to be capitalized is 1,26,000. What is the accounting entry you're going to post now? Plant and machinery account debited 1,26,000. What we derived as cost of the fixed asset. GST input credit 10,000. This is what you are going to pay to the vendor, right? 10,000 rupees. And you are posting here because you are going to take credit. And to vendor account 1,36,000. When I say 1,36,000, here vendor means all the vendors. I'm including ABC Limited and the vendors for freight, insurance, and installation. Now let's take a scenario that where GST credit you can't take. What will happen if GST credit is not allowed? Then it is very simple. Plant and machinery account debited 1,36,000. I am not posting a separate entry for 10,000 rupees because I can't take credit. And to vendor 1,36,000. Let's understand the meaning of depreciation on fixed assets. So depreciation is the gradual decrease in value of an asset over time. It is an accounting method that spreads out the cost of the asset over its useful life, right? In the first slide, do you remember we prepared water assets like chimney, gas stoves, or for example, you have furnitures. Now you have invested this amount, right? But every year there will be wear and tear, right? They'll have certain life. The furniture can be 10 years, the gas stove can be 3 years, the chimney could be 5 years. Now, whatever you have spent on those fixed asset, it has to amortize, it has to be depreciated every year, okay? Because that has to go to profit and loss account to determine the correct profit what the business is earning, even though it is capital in nature. But every year there will be one portion which will be going to profit and loss account to determine the right profit or loss earned by the business. All fixed assets are depreciated except land. Land will always appreciate, so there will be no depreciation on land. Life of asset is determined by the management team. Okay. However, the minimum rate to be applied in India is as per the Companies Act. So, Companies Act has notified the depreciation rates based on the number of shifts the assets are used. Right. If you are doing two shift, then there is different depreciation rate. If you're doing three shift business, then there is another depreciation rate. If you're doing one shift, then there will be a lower depreciation rate. Now, what are the depreciation methods? There are many depreciation methods, but commonly used is straight line method in the industry. Equal amount of depreciation for each year till the life of the asset. And generally, the formula is very clear: asset cost less residual value divided by number of years. So residual value means after 5 years, if you sell that asset in the market, in the second hand market, what is the amount you're going to get? It is very minimal, and very rarely I've seen any company uses that. They take the asset cost and charge the depreciation. There is another method, WDV, which is called as diminishing down value method. Under this, what happened? The calculation is very clear. Opening balance, that means the last year opening balance, on that you charge the depreciation rate. Capital work in progress. In short, it is called as CWIP. So capital work in progress is a term used to describe the cost incurred on a project or asset that is still under construction or development. So it is very clear the asset is not ready. The company has started investing on that asset, but on the date of reporting, on the date of preparing the financial statement, the asset is not ready for use, right? Hence, those will be called as CWIP. Now, CWIP is capitalized only when the asset is ready to use after confirmation from the user department, right? Because the user department has to install, test, certify, and then they will ask the finance team to capitalize it. No depreciation is charged on CWIP because the asset is not ready nor it is used in production, so no depreciation. Different internal order is created in ERP to track cost of CWIP pertaining to specific project. For example, the company may have 10 projects at the same time. You can't park everything in one ledger, right? Even though you park in one ledger, the company will create internal order. It is equal to like cost center. Okay. And all the cost relating to that particular project has to be parked in the internal order. So the person who is processing the invoice for those vendors has to ensure that they select the right internal order so that this cost can be parked in the correct internal order, and the finance team will go through each internal order and ensure that the business have opted for those internal orders with the expected date of capitalization, status of the CWIP, so that can be controlled. Now, how the accounting will happen for these cases? Till the cost parked under CWIP, that means when you're processing the invoice for the vendors, the entry will be capital work in progress account debited to vendor, right? Because at this stage, the asset is not ready for use. So you're parking under CWIP. And once you get confirmation from the business that the asset is ready for use and you receive the capitalization form, the entry what you're going to post now is fixed asset account debited to capital work in progress. Now let's get into the balance sheet reconciliation. Now, for example, you are the person who is responsible to perform the reconciliation. What are you going to check? What are the items you need to validate? Okay. So let's start with the first point. Fixed asset register and asset ledger balance, right? So all assets created and deleted are captured in fixed asset register, and all accounting ERP has this report, right? Even your auditors will ask for this report when they start the audit. Ensure the closing balance of gross block and accumulated depreciation tallies with the balance reported in the fixed asset ledger, right? So both has to match the fixed asset register balance and the general ledger balance, or you can say trial balance ledger amount has to match. Even the asset category like building, plant and machinery, etc., need to be matched because you may have different GL for building, different GL for plant and machinery. Similar in fixed asset register, you can filter out what is building, what is plant and machinery, and see that at that sub asset level, whether the amounts are tallying from the FIR to asset ledger. This is very important. Otherwise, it will be difficult for you to justify that why there is a difference between fixed asset register and ledger. Could be a situation that somebody has posted a direct entry to that ledger recon account. We don't know, so you have to verify that. Review assets added during the month. This is very important. Check all assets during the month and ensure the fixed asset category used is correct. Okay, that means if somebody has wrongly used, then you have to rectify that. For example, here should not be a situation where laptop accounted as furniture, right? That means somebody has accounted wrongly. In your review, it should be traced and then you should rectify that. Review all the high value assets capitalized with backup documents like invoice value, installation certificates, capitalization form, budget approval. Not possible to do for all assets, but at least the top high value assets which are added during the month, you should verify that. Next one, review assets deleted during the month, right? Ensure all assets deleted are accounted correctly. Both gross block and accumulated depreciation has been removed from the FIR and ledgers, right? Check the amount received from the customer is netted with the asset WDV and necessary profit loss on the sale of asset is accounted. Pick high value sales and review the PO agreement with the customer to see that whether the sale or the invoice raised is matching with the contract or not. Next item to be checked is depreciation. Check depreciation for all assets. No asset should miss depreciation posting. The meaning is very clear. At the month end, when you run the depreciation run in your ERP, please have a look that all the assets are depreciated. So when you're doing the reconciliation, download the report from FAIR and see that for each line there is a depreciation posting. Okay, it's not be a situation that particular class is not depreciated and particular lines are not depreciated. Generally in ERP, these mistakes will not happen, but as if there is a bug, it is possible. So checking is better than assuming it. For assets added during the month, check the depreciation rate. Okay, this will give clarity that the accountant who has posted the entries for assets have considered right life of the assets. The rates should be as per the depreciation maintained in the ERP. If there is any modification in the depreciation, then that has to be validated with an approval document. Sometimes it may happen that business would have requested saying that this asset will get depreciated within 2 years or 3 years, which may not match with your depreciation maintained in your system. So if you have a deviation, then it's better to have approval from the business, because tomorrow when there is an audit, you have to provide those documents to the auditors. Review of capital work in progress. This is one of the very critical item, and you should ensure that these are properly reviewed. Review the aging of capital work in progress. Justification from business controller has to be obtained for each CWIP line item, or you can say POs, for the reason to keep under CWIP, right? Because when you're doing the reconciliation, you are authenticating or you are ensuring that these lines are not ready for use, right? Hence, these lines are reported under CWIP. An expected date for capitalization has to be mentioned in the reconciliation. That will give a clarity to the management or to the auditors that you have a control from the business that on which date this CWP are to be capitalized. Next point is physical verification of assets. Ensure the management team is conducting the physical verification of assets as per the company policy. There are companies who cover all the assets in 1 year. If the number of assets are higher, then company can do in 2 years. So you go through the policy and based on that, you check that whether the physical verification is happening on time or not. Ensure all discrepancies identified during the physical verification are adjusted in fixed asset register after obtaining necessary approval from the user department. So if some assets are completely depreciated or some assets are not found during the physical count, then you have to delete those from the fixed asset register. Review of repairs and maintenance ledger. Very critical point. This is review the repairs and maintenance ledger and ensure no capex or fixed assets items is accounted as repair and maintenance. So if you find some asset is accounted as repair and maintenance, then you have to regroup it and capitalize. Coming to the next point, impact of foreign currency restatement. Even though asset is purchased on credit, any restatement of foreign liability should not impact the cost of fixed asset. Sometimes people get confused, and when they restate, the difference between the actual entry and the restate amount, they take it and park it under fixed asset. That is wrong, because in the cost definition, we never so that any forex impact will be accounted as part of the cost. Hence, ensure that this is not loaded to the fixed asset cost. Ensure that the restatement impact is accounted under unrealized forex loss and gain. Even realized forex loss and gain need not be adjusted with fixed asset value. This treatment is different under Indian Income Tax Act, where the realized portion is adjusted with the asset. But when it comes to your statutory books or your local requirement, in that case, you need not add the realized forex loss and gain. The last one is impairment of fixed asset. Very important. Ensure that the company is doing the impairment testing of fixed asset. If the future cash flow is weak and there is risk for impairment, then provision for the same has to be accounted. Many company perform this quarterly. Few company they do yearly. But if the business is doing good, you have good amount of gross profit earned by selling of products, then no need of doing the impairment. But yes, certain companies follow specific deadlines to do this impairment. So if that is there, when you're doing the reconciliation, please have a look on the impairment testing or calculation and see if any provision is missed or not accounted. So that's it on the fixed asset. I hope you like this video. Please subscribe to the channel, share with your friends so they understand more about the fixed asset. I'm doing a lot of series of videos on balance sheet reconciliation. The first video on trade receivable is already there in the channel. I'll be making few more. Thank you for all your support. Bye bye.